This video covers the carbon economy, sustainable finance, and regional transition, presented by T.S. Dr. Norsaidatul Akmar Mazelan of the Sustainable Business Network Association, Malaysia. We are navigating the future of finance and development within the green economy. This includes exploring carbon markets, sustainable finance, and regional transitions that are reshaping global economic development. The carbon economy is about redefining value. Emissions now have a price, and reducing them creates new opportunities. We will now delve into the economic systems and market mechanisms that underpin the carbon economy. Carbon pricing is the new economic engine. Markets are moving from policy aspiration to economic reality, essential for reaching net zero. 24% of global emissions are now covered by pricing instruments, generating over $100 billion in revenue in 2024 alone. This is also a key driver for investment in developing economies. Carbon markets unlock significant investment. By 2030, $40 billion in climate financing could be unlocked. ASEAN has the potential for $3 trillion in revenue by 2050 and the creation of 13.7 million green jobs. The African Union Action Plan is mobilizing this potential for low-carbon technologies. This chart illustrates global carbon pricing growth. Note the price per ton for the EU ETS and China ETS and the high variance in voluntary markets. ASEAN is targeting market expansion by 2030. Carbon market mechanisms involve compliance markets, which are regulated systems like the EU ETS, and voluntary markets for offsetting emissions. A key focus is on Article 6 alignment for transparent cross-border trading. Carbon markets drive decarbonization by pricing carbon and assigning a real economic cost to emissions. They mobilize capital for green projects, reward actions that incentivize businesses to decarbonize, and scale solutions by funding nature-based and technology solutions. Sustainable finance involves investing in tomorrow by integrating environmental and social criteria into every financial decision. We will now discuss sustainable finance, focusing on integrating ESG into decision-making. The pillars of ESG finance include environmental factors like resource management and climate strategies, social factors such as labor practices and community engagement, and governance, covering internal controls, transparency, and ethical frameworks. ESG investment strategies involve impact investing for measurable results, ESG integration for financial materiality, green bonds for dedicated project funding in renewable infrastructure, and negative screening to avoid harmful sectors. Transition finance bridges the green gap. The challenge is transforming emissions-intensive industries that cannot simply be switched off, such as steel and cement. The opportunity is to redirect capital, support emitters with credible transformation plans, and align financing with long-term Paris-aligned climate goals. The Baku to Belém roadmap aims to mobilize $1.3 trillion annually by 2035 to support climate action in developing countries. This includes replenishing grants, rebalancing fiscal space, rechanneling private finance, and reshaping capital flows for equitable access to climate finance. The next frontier of sustainable finance is funding the transformation of carbon-intensive sectors. This requires new instruments, blended finance, and strong public-private coordination to move capital where it is needed most. Sustainable transition must be regional. Every region has its own starting point, challenges, and path forward. Localizing sustainability is essential for effective global change. Our focus now shifts to the regional transition, emphasizing localized shifts for sustainable development. Southeast Asia faces unique challenges in a low-carbon shift, where over 100 million jobs are environment-linked. Key priorities include supporting the large informal economy, ensuring energy governance protects labor, and mapping global principles to regional aspirations. A one-size-fits-all approach won't work. The regional approach, like the EBRD's Green Economy Transition Strategy, addresses specific needs, market environments, and climate vulnerabilities, especially for countries more emissions-intensive than the global average. Addressing localized shifts requires community inclusion, ensuring carbon market strategies reflect local needs. It also demands coordinated energy and industry shifts and regional harmonization through frameworks like the proposed ASEAN Common Carbon Framework. Building sustainable futures means lasting transitions must be inclusive and locally grounded. This approach ensures sustainable development delivers shared prosperity, moving beyond just aggregate statistics. The window for climate action is closing. Acceleration requires faster disbursement of climate funds, mobilizing broader private finance, making resources accessible to vulnerable countries, and ensuring predictable multi-year financial commitments. The future is green. This transition is the defining economic opportunity of our era. We must leverage carbon markets, sustainable finance, and regional transitions to build a future where economic prosperity and environmental health are inseparable. We now look at global case studies of just transition. We will compare coal phase-outs, labor impacts, and policy frameworks across different continents to understand what works and what barriers exist. In Germany's Lusatia region, the coal phase-out affects 8,800 workers. Measures include innovation clusters and site remediation, backed by €1.5 billion in priority spending. Key challenges include rural infrastructure gaps and earning community trust. Poland's Silesia region has undergone slow structural transformation since the 1990s, affecting over 80,000 miners. Measures included early retirement packages and car manufacturing hubs, creating 76,000 new jobs. A key barrier remains union and government resistance to change. South Africa's Mpumalanga is just starting its transition. Coal powers 85% of its electricity, with high unemployment. Transition measures include renewable energy auctions and a green economy strategy. The political divide and Eskom's debt crisis are key barriers. South Africa is also addressing state-owned enterprise governance reform, particularly Eskom. Measures include increased public disclosure and transparency in procurement. Institutional corruption and high government debt remain significant barriers. In Indonesia's East Kalimantan, the transition is yet to begin in earnest, despite the JETP partnership. Over 136,000 workers are affected. Measures include a moratorium on new mining licenses, but barriers include PLN opposing renewables and widespread illegal mining. In Appalachia, U.S., the long-term decline from 1980 to 2019 focused on coal mining with no active industrial replacement. Affected workers include non-college educated individuals and the poor, suffering permanent earnings losses of 13 to 25% and higher mortality rates. The Philippines is pioneering with the Green Jobs Act of 2016, legally defining, quote, green jobs. Key measures include right-skilling initiatives and blended finance schemes. Barriers include low rule of law scores and delays in protecting ancestral domains. India is seeing emerging renewable expansion supported by green finance, such as Greenco Group's bond issuance and tax-exempt IREDA bonds. Labor reskilling includes skill impact bonds. However, barriers persist with high capital costs and continued reliance on coal. France and the city of Paris have actively implemented green transition, guided by the Paris Agreement and the EU Green Bond Standard. They issued sovereign green bonds totaling €7 billion, leading to an annual CO2 reduction of 2 million tons. China's transition is driven by supply-side reform in energy-intensive industries, like agrochemicals. Measures include factory shutdowns of high-polluting entities. A key barrier is the perception of environmental protection as an economic obstacle by some local authorities. Thailand is in the designing phase, focusing on energy sector decarbonization and battery manufacturing. Vietnam is piloting its transition with the Just Energy Transition Partnership and a pilot ETS starting in 2025. Both face barriers in clear policy, financing, and inclusive consultation. In Southeast Asia, 93% of vulnerable workers are in the informal economy. Cambodia is focusing on MSME growth using guarantee schemes like the Credit Guarantee Corporation of Cambodia. The regional approach targets 2030 ASEAN goals. Successful transitions require robust financing, inclusive stakeholder dialogue, and proactive labor reskilling. Institutional barriers like corruption, fragmentation, and political resistance remain the most persistent challenges across all regions. Key takeaways emphasize that social compacts build trust, finance must be targeted towards affected communities, and reskilling is non-negotiable to prevent permanent earnings loss. Ultimately, governance determines the outcomes of a just transition. Thank you for watching this video on the carbon economy, sustainable finance, and regional transition. You can reach Dr. Norsaidatul Akmar Mazelan via email or mobile for further discussion.